Let's continue with our consolidation accounting of the parent and the sub and go into the second year of activity. The activity from the second year and beyond is the same. So in the examples we're going to do, we'll do the initial investment, year one, which is a little different because we have that initial investment included in there, and then year two and beyond are the same. In this instance, we still see net income and dividends. I'm giving it to you here, but you could pull it from the three-part worksheet again, which you have in front of you. The dividends as well are there. So let's go through the process again. Now remember, with the consolidation process, we hit on this a little earlier in some other lectures, is that the consolidations happen in the middle. They don't go to the parent's records and they don't go to the sub's records. But the activity between the parent and the sub under the equity method, so that current year activity that happens, those items stick onto the parent's records and stay. So each and every year we're going to have this activity between the parent and the sub, and we're going to have to record that. Alright, so let's go ahead and record the subsidiary's net income again. Subsidiary report net income of 112. We're going to debit the investment sub, credit income from subsidiary. We'll do the same for the dividends. We'll debit cash, credit investment subsidiary for the dividend amount of $60,000. We recap those. Here's what we get. And I would suspect that based on the prior information, you should be able to do these two journal entries pretty quick-like from the information, just because you've learned a little bit the process. Let's reconcile our investment subsidiary again. Notice the beginning balance of 480 was the ending balance of 480 from year one. The investment subsidiary is a balance sheet account, so it maintains a running balance. And again, that goes back to the concept, hey, those current year activity entries get posted, they don't go away, and they stick on the parent's balance sheet. We record the net income, we reduce it by the dividends, we get an ending balance of $532,500, and we see that our investment sub account is $532,500. Again, you need to practice reconciling this investment subsidiary account. Going forward, I could potentially give you the ending balance and ask you to tell me what is the beginning balance. I could also ask you what is the initial investment based on this. Given you the right information, you could start with this ending balance of $532 and compute the beginning balance or the initial investment in this particular example. We need to do the book value calculation, and again, this schedule here is the investment subsidiary. It's a running schedule, so the beginning balance of 480 was the ending balance of last year. Same thing for the common stock and retained earnings. Notice that the retained earnings of 180 includes year one's net income minus the dividends. The same thing can be said for this year. Alright, let's start the consolidation process for the end of year two. You have the three-part worksheet in front of you. We know what net income is. We can see that, $112,500, and we see the dividends of $60. Alright, let's begin with our eliminating journal entries, which is going to be the current year activity between the parent and the subsidiary. we're going to debit income sub, credit dividends, credit the investment for 112, 60, and 52.5. We're also going to eliminate the subsidiary's equity at the book value. That is going to come from our book value computation schedule, and that is going to be the beginning numbers. It's going to be the beginning numbers. You may want to make a note somewhere in the notes that you're taking that this entry will come from the beginning balance. It will always come from the beginning balance in year 2. In year 1, it's going to come from the initial investment because our beginning balance is 0 in the acquisition year. We recap our EJEs, and we can post them to the 3-part worksheet. In this example in year 2, I went ahead and posted them for us since we've done that once already. One thing again to notice, look at the retained earnings beginning. You'll see in the EJE column, EJE number 2, 180 is posted at the beginning number. It's not posted at the end because that ending number of 232 includes the current year income less the current year dividends. Notice that the information from the net income flows down to the retained earnings. The 112,500 flows down. The ending retained earnings EJEs of 292,500 and 60 flow down to the ending retained earnings in the balance sheet. So the 3-part worksheet works hand in hand as the information flows from the top, trickles down to the middle, and then to the end. The last thing we need to do is consolidated net income. Again, for this one, we're going to start with parents' net income of $352.5. We're going to subtract from it the income sub. Remember, we want to have a good number that represents income from all sources other than related party. That's 240. Our subsidiary's net income is 112. The adjusted net income is 112. Our consolidated net income is $352.5, which again equals the parent's net income.